Hello friends, today I'm going to be talking about how to avoid capital gains tax when selling an investment property. Have you ever met anybody that's actually excited to pay taxes? I didn't think so. And real estate investors are no different. Matter of fact, the saying out there goes, the only sure thing in life is death and taxes. However, in real estate, there are ways to avoid capital gains taxes. And by the end of this video, I'm going to show you exactly how you can avoid capital gains taxes and share with you a real life example that I've had in doing just that. As we go into this video, I first want to help you understand the difference between ordinary income tax and capital gains tax. Next, I'm going to share with you the vehicle that will help you avoid capital gains taxes when selling an investment property. And finally, I want to break down for you the wrong way to use that vehicle and the right way to use that vehicle, and how I've done both and how you can learn from my experience, both good and bad. If you're ready, let's go. So let's talk ordinary income tax. We should all be familiar with this, right? Uncle Sam has to take his share and we're all paying it. Now, your income tax varies on the specific tax bracket that you're in. And this depends on how much money you make throughout the entire calendar year. And tax brackets vary depending on if you file as an individual or jointly married. And it typically varies between 10% up to 37% depending on how much money you make. So a quick example, let's say that you're at the highest tax bracket. Let's say you made $500,000 last year. And if you're at 37%, you're paying close to $175,000 in tax. That's a big chunk of change going to Uncle Sam. Now let's talk capital gains tax. This is tax that is paid on income that is derived from a sale of an asset, such as a stock or a piece of property considered a capital asset. And these tax rates vary from 0% up to 20%. Now, if your income is $44,000 or below, you pay 0 in capital gains tax. If you're between $45,000 and $492,000, you're at 15%. And if you're above $492,000 in annual revenue, you're at 20% capital gains tax when you sell a capital asset, being a stock or a piece of property. Here's one other cool thing about real estate. If it is your primary residence, where you live currently, and you sell that piece of property, you are actually exempt from paying any capital gains taxes up to $250,000 if you're an individual, and up to $500,000 if you're married or you file jointly. But here's the caveat. Here's something you really need to be aware of when it comes to capital gains tax. If you hold the asset for less than a year, let's say you purchase a piece of property or a stock and you sell it within 12 months, that is actually counted as ordinary income, not a capital gains tax. In order to be different from ordinary income tax or capital gains tax, which can be anywhere from 37% down to 20% on the high end, or much lower than that on the lower end, you have to hold the asset for at least 12 months. If you don't, you'll be taxed at ordinary income tax, which, like I mentioned, could be almost double that you would pay in tax. And honestly, I believe this is why so many millionaires have been created in real estate. I mean, let's think about it for a second. If you're making $500,000 a year and you're doing it through real estate, through holding properties for more than 12 months, or rentals. Now, the rental income coming in could be taxed at ordinary income, but if you hold a piece of property and you turn around and sell it, and let's say you make $300,000 from that property, obviously you're going to be taxed at 15%, versus if you made $300,000 as an individual, you're going to be taxed close to 30 to 35%, almost double. So people who are doing real estate, if they're holding it and flipping it past 12 months, they're paying almost 50% less in tax than individuals that are just earning it through their ordinary income. Now, that's not always the case, but you start to realize this when you get involved in real estate, that holy cow, I'm able to write more off, I'm able to depreciate some of these items, and I'm paying less in tax than I did if I had a normal job. I'm not saying quit your day job and jump into this specifically, but I think understanding that is really important about how much less you pay in taxes when it comes to real estate. Now let's talk about the vehicle that will help you avoid capital gains tax when it comes to selling your investment property. And that vehicle is called a 1031 exchange. Now, there are some other ways to avoid capital gains taxes, like purchasing a property through a retirement account or converting an investment property into a primary residence. But for this episode, let's focus on a 1031 exchange. And what is that? It's derived from the tax code 1031 in the tax law. And it's important to note it isn't completely tax avoidance. It's deferring the tax. So what does that mean? Let's say that you own a piece of property for $100,000 and in 2 years later you sold it for $150,000. Now, typically you'd be taxed on the gain of $50,000. However, if you took that and you 1031 that property into another property, right? Let's say that $150,000 property that you sold, you then bought a property for $200,000 and you held it there, you pay zero tax on that gain. However, if you sell that $200,000 property, say 5 years later for $300,000 and you pocket the money, you will be taxed at a capital gains rate of anywhere between 0 to 20%, depending on which tax bracket you're in. And so it's not like you're avoiding the tax completely. You're deferring that tax until it's ultimately sold. Now, you could do that time and time again, and I'll talk about at the end of this video what the best way is to do that to avoid taxes for as long as you can. But for this purpose, you got to understand that you're not avoiding taxes completely, right? You're deferring the taxes until the final sale where you're putting the gain, all of the gain in your pocket. You'll be taxed anywhere between 0 to 20%. So this is how a 1031 exchange works. First off, when you sell a piece of property after you've held it for more than 12 months, you have to purchase something that's a like kind. Meaning, for example, you can't sell a piece of property and buy a Lamborghini, right? You sell a piece of property, you have to buy another piece of property. And the key is you have to identify which property you're going to buy within 45 days, and that transfer has to happen within 180 days. And the other important thing to note, it has to be of equal or greater value. So if you bought a property for $200,000 and 5 years later you're selling it for $300,000, whatever you 1031 that into has to cost more than $300,000, and it has to be identified in 45 days and closed on in 180 days. So those are a few specifics that are important to understand when it comes to 1031 exchange. Now, obviously, I'm not a tax expert and I don't profess to be one. And even though I feel comfortable in these concepts and I've done them before, I will still go out and hire an accounting firm to help me with the specifics of a 1031 exchange. These individuals understand it, they know the specifics, and it doesn't cost that much money at all. And they're able to help you put all the proper paperwork in place to make sure that the 1031 exchange goes through the right way. I just don't want to make sure that I miss a few I's that I didn't dot or I didn't cross a few T's. Having an accounting firm help you do this is money well spent. Let's talk about my experience. In other videos, I've talked about my first deal in real estate with some fourplexes that I bought. There was a time where I found some property in a beautiful area. It was land, it was a pasture, it had streams through it, it had beautiful views, and I thought, you know what, I'm going to sell these fourplexes and buy this land. So I 1031 these fourplex sale into the land and bought the property. I didn't pay any tax on that. However, as a young real estate investor, I didn't really understand that by doing so, I'm taking money from an asset that's producing income to something that's not. Now, it made a little bit of income through some rental and other things like that, and through some agricultural farming that was done, and they were paying me for that. But I had taken money from something that was producing income and put it to something that wasn't. That was not a very smart thing to do. And that's why I said you can learn from my example, both good and bad, right? If I had to do it all over again, here's what I would do, and this is what I'd recommend you do if you ever engage in a 1031 exchange. If you find a piece of property that you have and you want to sell, and eventually you want to avoid the capital gains tax or defer the capital gains tax, I would take that property and I would take that gain and I would put it into an income producing property, like a fourplex or an eightplex or an apartment building or a short-term rental. Because when you put it in there, you defer the tax, but you're making income from that property. Now, you're still taxed on the income that you make from the property, but that capital gains tax sits there and you don't have to pay any tax on the gain, but you're making income. So my recommendation for you is when you do this is to find a rental property that you can put that gain into and enjoy the benefits that come from income coming in every single month. Now, this is my strategy. This is what I've done. This is what I've liked to do when it comes to avoiding or deferring capital gains tax when selling an investment property. But I'd be interested in your feedback. What do you think? What have you seen work well for you? Comment below. I'd love to enter in a dialogue with you. And as always, I've got a free gift for you. Just click on the link below, aaronsfreetraining.com. It's a short-term or vacation rental calculator that when you put in all the input, the purchase price, the expenses, it's going to spit out to you whether it's a good deal or not, or a great deal, and it's free below. Once again, thanks for stopping by. Appreciate you. Have a great day.